Chapter 11. Financial Market. Question 6. Justify the following statements. 4 marks each. 1. Financial market acts as link between investor and borrower. Answer. 1. Financial market is a market where buying and selling of financial assets, that is financial instruments, take place. 2. Financial instruments are monetary contracts between two parties. It is in the form of legal agreement, having a monetary value. They can be created, traded, modified, and settled. 3. Financial instruments are assets for one party, that is lenders, and liability to another party, that is borrowers. Examples of financial instruments are shares, bonds, debentures, derivatives, commercial papers, etc. 4. Financial market facilitates raising of funds for long term through the capital market, as well as for short term through money market. 5. Individuals, corporates, firms, etc., who have excess funds, are lenders or investors in the financial market, whereas corporates, government, individual traders, etc., who need funds for business purpose, are borrowers. 6. Financial market serves as an intermediary between investors and borrowers by mobilizing savings and converting it into investments. 7. Financial market facilitates productive use of the idle funds. It transfers the money, or capital, from those who have surplus money to those who are in need of investment for productive usage. 8. Financial markets are readily available, anytime, for both the investors and the borrowers. They provide a platform through which investors and corporates can find each other easily. 9. Thus, financial market acts as a link between investor and borrower. 2. Money market makes available short-term finance through different securities. Answer. 1. Money market is a market where lending and borrowing of funds take place for a short-term period, varying from 1 day to 1 year. 2. Only those financial instruments are traded in money market which are immediate substitute for money. Following are some of these financial instruments. A. Call money and notice money. When the funds are lent or borrowed for a very short period, that is 1 day, it is called as call money. When the funds are lent or borrowed for periods between 2 days to 14 days, it is called as notice money. Call money and notice money market is also called as interbank market, as it facilitates a bank facing temporary shortage of cash. B. Treasury bills. T-bills are the short-term securities issued by RBI on behalf of the central government to meet the short-term funds requirement of the government. T-bills have short-term maturities with highest up to 1 year. T-bills are issued for a minimum value Rs 25,000 and thereafter in multiples of Rs 25,000. They are issued at a discount to the face value. At maturity, the investor gets the face value amount. C. Trade bills or commercial bills. Bills of exchange are negotiable instruments drawn by the seller, that is drawer, on the buyer, that is drawee, for the value of the goods delivered to him. Such bills are called trade bills. In case the seller wants immediate cash, he can discount the trade bills with commercial banks. When trade bills are accepted by commercial banks, they are called commercial bills. D. Commercial papers, CPs. Commercial paper, CP, is the short-term, unsecured promissory note issued by large corporates, financial institutions like SYJC-SP, Exim Bank, etc., and primary dealers, with a fixed maturity period varying from 7 days to 1 year. The minimum face value of CP is rupees 5 lakhs, and thereafter, in multiples of rupees 5 lakhs. It is issued at a discount to the face value. E. Certificate of Deposit, CDS. CDS are unsecured negotiable promissory notes, issued by commercial banks and financial institutions. CDS are issued for a minimum of rupees 1 lakh, or in multiples of rupees 1 lakh thereafter. CDS can be issued at a discount to the face value. The maturity period of CDS ranges from 7 days to 1 year, if issued by banks. Other financial institutions can issue a CD with maturity ranging from 1 year to 3 years. 3. Thus, money market makes available short-term finance through different securities. 3. Capital market is useful for corporate sector. Answer. 1. Capital market is a market for borrowing and lending long-term financial securities and instruments. 2. It is a market where financial assets having long or indefinite maturity period, like equity shares, preference shares, debentures, bonds, government securities, public deposits, etc., are dealt with. 3. These financial instruments are issued by corporates on a large scale to meet various corporate finance requirements. 4. Capital market provides funds for medium and long term. It does not deal with channelizing saving for less than 1 year. It enables corporates to access long-term funds from domestic as well as foreign markets. 5. Capital market deals in marketable and non-marketable securities. These securities are useful for corporates to raise long-term and medium-term finance for expansion and diversification. 6. The investors in the capital market comprise of individuals, like general public, and institutional investors, like mutual funds, insurance companies, financial institutions, etc. Therefore, it consists of wide variety of investors. 7. Capital market links investors with borrowers. For this, capital market makes use of different intermediaries, such as brokers, underwriters, merchant bankers, collection bankers, depositories, etc. 8. Thus, capital market is useful for corporate sector to raise huge amount of funds from different parts of the country. 4. There are many participants in money market. Answer. 1. Money market is a market where lending and borrowing of funds take place for a short-term period, varying from 1 day to 1 year. 2. There are many participants in money market, and following are some of them. 1. Reserve Bank of India. RBI regulates money supply and implements its monetary policy through the money market. It issues government securities in the money market on behalf of the central or state government, and also underwrites these securities. 2. Central and state government. Central government is an issuer of treasury bills, that is T-bills, in the money market, through which it borrows money. The T-bills are issued by the RBI on behalf of the central government. Banks, corporates, etc., lend to the government by buying the T-bills because of its risk-free nature. 3. Public sector undertakings, that is PSUs. PSUs issue commercial papers in the money market to finance their working capital requirement. Some PSUs generate large cash surpluses, which they invest in money market instruments, like certificate of deposits, T-bills, etc. 4. Scheduled commercial banks. Scheduled commercial banks are considered as very big borrowers and lenders in the money market. They participate both as borrowers and lenders in call money market, short notice market, repo market, and reverse repo market. 5. Insurance companies. General insurance companies and life insurance companies are usual lenders in the money market. Generally, they invest more in capital market instruments, and hence, their role in the money market is limited. 6. Mutual funds. Mutual funds offer varieties of schemes to investors for investment in money market instruments. Mutual fund schemes are liquid schemes. They collect money from many investors to invest in money market securities.